This week's outlook. We'll obviously start in the geopolitics page, just going over the developments that has taken place over the weekend. Essentially, the conflict in the Middle East continues to show no signs of de-escalation. We're seeing bond yields rise. US oil was obviously very, very elevated, and the VIX is above the 25 key level, which is just indicating a lot of risk off. Very risk off for sure. Over the weekend, developments haven't gotten any better. Goldman Sachs came out yesterday and said that oil shipments through the Strait of Hormuz have nearly stopped. Obviously, the UAE is telling residents to evacuate certain ports, and the US bombed the Karg Island on Saturday or Friday, which is responsible for 90% of Iran's oil exports. As you can see in the terminal here, all the data coming out is just saying gold upside, equities downside. And if we go down here, it's supporting dollar strength. Yeah. So if we just toggle this to only Middle East, we can see dollar upside, dollar upside, dollar upside, dollar upside. All this is pointing to dollar upside. So yeah, that's essentially it on the geopolitical front. The risk heat map is clearly showing that the Middle East is a 10 out of 10 on conflict. Until we see some signs of de-escalation, energy and metals, obviously crude is about to reach 100 again. Gold's been struggling a bit due to the dollar strength, but all this is pointing to very much continued escalation in war and very little signs of a resolution. So, moving on to the calendar. If we go on our watch list for this week, we will, yes. So, this week we are extremely busy with 7 central bank meetings, which is something, I've not seen in ages. This is such a busy week for data. And the theme from the meetings should be pretty boring. They're all going to sound pretty similar. It's just going to be talking about how inflation is going to be a key risk from the ongoing conflict, obviously due to the elevated oil prices, which allows the central bank to have a more wait-and-see approach. So on Monday, we've got Canada's inflation print. On Tuesday, we've got the RBA, which are forecasted to hike. We'll go over that in the AUD section. Wednesday, we have the Bank of Canada, the Fed, so 2 very big ones there. And then on Thursday, we've got the Bank of Japan and Bank of Japan, Bank of England, and the ECB. So we've got 3 central bank events on Thursday. So if volatility wasn't going to be elevated already from the conflict going on, this is going to add to it. So, essentially this week, because there's so much data, you need to be in and out. You want to be maybe going down to some lower time frames, just so you don't get caught out by some of these data releases, because you don't want to be in an Australian dollar long before an RBA decision, which you could get a buy the rumor, sell the fact reaction if they do hike. If they don't hike, that could be seen as them being cautious, and that's obviously hasn't been priced in, so you're going to see a negative reaction. So you just need to be careful. But yeah, let's get into the fundamentals, starting with the US dollar. So, starting with the US dollar, not much has really changed from last week. Conflict is ongoing, which is keeping US oil elevated and should support the greenback for as long as this continues. Last week's data was pretty much irrelevant, that obviously being CPI, as short-end yields continue to point higher. However, short-end yields are rising in every country due to the spike in energy prices, so trading rate differentials is going to be pointless in our opinion, especially with dollar pairs. And this is why we stick with our energy divergent crosses. So we're looking at stuff like euro dollar, dollar yen, GU. Those are the main 3 for dollar crosses in our view. So yeah, that is really it with the dollar. ANZ are talking about bearish dollar here, but that's only against the Australian, and this is obviously in relation to the RBA meeting, whereas Bank of America, Morgan Stanley, ANZ are here all supporting the dollar for now. And as mentioned, as long as the conflict continues, we're going to see inflows into the dollar. It's evident. So it's more just about getting in on the pullbacks. The Fed this week's going to be definitely interesting and important, but evident from the Canadian labour market the Canadian labour market report that came out on Friday, short-end yields immediately retraced it, basically saying we don't care about your labour market or any of that. We care about inflation at the moment. Inflation is the main concern. but we'll get onto that in the Canadian dollar section. So yeah, bullish on the dollar this week. On the pound, we are bearish on energy crosses. Pretty much the same as last week as well. Macro-wise, we were extremely weak in the UK and will continue to get weaker if energy prices remain this elevated. So for as long as they do, meaning as long as the conflict continues, we should see a weaker pound. However, you need to be careful on pullbacks, especially if you plan on taking euro pound, meaning don't hold for too long. Get in and out, because Credit Agricole here mentioned that UK investors have adjusted their Bank of England rate expectations. They've adjusted their Bank of England rate expectations more aggressively than Europe, which makes sense, especially as they are both big energy importers. So if you look here, you can see that, the first is the fact that the UK rate investors have adjusted their Bank of England rate expectations more aggressively than other European investors in response to the latest oil price rally. As a result, the pound has regained some advantage over the euro. So yeah, something like pound euro, it's not even on my watch list, because to me it's a week versus week right now. So yeah, bearish on the pound on energy crosses. So GA, GCAD, GU, obviously, G-Swiss potentially, but we'll go through Swiss, why you need to be a bit more careful with that this week. But that is the pound. Moving on to the euro. Bearish on the euro. Europe are getting hit from the high energy prices, whether that's oil, LNG or nat gas, which is obviously not good for Europe. And as a result, we are starting to see the market priced in an ECB rate hike. However, rate differentials are clearly not driving price at the moment, as mentioned, but also a rate hike doesn't automatically mean that we're going to see this support the euro, as rate hikes when the economy is fragile typically does more harm than good, because obviously you're now restricting money supply and all this sort of things. This is why we are still looking for shorts on Euro AUD, Euro NOK, Euro CAD, Euro Dollar, and potentially Euro Swiss, but we'll go over that as well. So yeah, bearish on the euro this week. Moving on to the CAD. We are bullish on the CAD. So it's quite self-explanatory, this one, but as long as tensions are high and oil remains elevated, we are going to see flows into the Canadian dollar. The twos have retraced the initial downside push from the weak labour market print on Friday. This is basically just saying that the market cares more about the inflationary pressures from the Middle East over the weakening labour market as of now. Oil is the main driver of CAD, and for now it's pointing to upside. However, once de-escalation starts to get priced in, the CAD is in for a bumpy ride. So as soon as we see some developments moving towards, a meeting, which will be evident from oil's movements, as soon as oil starts falling, yields are obviously going to start falling again, and the Canada is one of the not best positioned macro-wise, so that will just add fuel to the fire for the downside move. So if you want to get into some long-term positions, CAD downside is beautiful now. You can definitely look for some downside positions for sure. Australian dollar. We are bullish, but on specific crosses, meaning, it's evident that the Australian dollar's upside potential is being capped from the dip in gold and equities. However, the energy divergence continues to play out, which is why GA, AJ, Euro AUD, and AUD NZD are my main focus this week on Australian dollar. It's all about picking the right cross. On to New Zealand. Well, actually, before we do that, Australian dollar, obviously we've got the RBA this week. Essentially, Credit Agricole, ANZ, Goldman, they're all basically forecasting a rate hike. However, Credit Agricole are saying that beware of a knee-jerk reaction, meaning we could get a buy the rumour, sell the fact. So essentially, just don't be in any Aussie positions during the central bank meetings. However, leading up to the meetings, expect some strength, which obviously the meeting's on a Tuesday. So Monday, I'd be looking for Australian dollar strength. Moving on to the New Zealand dollar. New Zealand dollar. As mentioned last week, New Zealand imports most of its crude oil and refined fuels, making it typically suffer in the current environment. Not to mention that the biggest oil importer in the world is China, which is why the dollar against the Chinese yuan is having a pullback, which will put pressure on the Antipodean currencies, especially the New Zealand dollar, due to their low energy exports, which is why we remain bearish on the Kiwi. Bank of America say it here. Oil higher, equities lower, short the New Zealand dollar. Simple. So yeah, we see short New Zealand dollar as a cheap tactical hedge, but note the tailwinds for this trade are likely to fade unless risk sentiment continues to remain bearish. And obviously sentiment is very bearish at the moment, so this supports short New Zealand dollar. which is why we've seen like AUD NZD rally, NZD dollar fall off a cliff, and that's what we've been calling for the past couple of weeks. So, well, since the conflict has kicked off. Moving on to the yen. We remain bearish on the yen. As mentioned last week, they import over 80% of their energy, which makes yen shorts one of the most clear energy divergences at the moment. Yields, as we know, are not driving price at the moment. However, they are also pointing to yen downside. Not to mention global yields rising, which typically worsens Japan's bank sheet, which is another factor pointing to downside. Yeah, I mean, you can talk about rates all you want. You can talk about or hawkish BOJ, but at the end of the day, the conflict in the Middle East is what's driving price at the moment, and that is pointing to downside with the yen, which is why we're getting in on some nice dollar yen upside, CAD yen upside, those sort of crosses. Now the Swiss franc, we actually are neutral this week on the Swiss franc, and you definitely do have to be careful. I mean, primarily due to gold's movements being the main driver of the Swiss franc, meaning you can get caught off guard with the gold weakness from dollar strength, which will put downward pressure on the Swiss franc. So what you could do is hedge your Swiss franc longs with some dollar longs. But yeah, we think that at least for gold, you need to be careful because the dollar is extremely strong. We've just broken the 100 handle on the DXY, which is why we're seeing a lot of downside pressure in gold. And obviously that's going to cap Swiss franc gains. So yeah, definitely be focused on like the cross asset correlation, but apart from that, yeah, you just need to be very careful with it. Look where gold is at when you're trying to enter, and just be very careful. So yeah, that is all the macro or the fundamental analysis this week. Now let's get into the technicals. So moving on to the technicals. Obviously, this 100 handle was respected last week on the DXY. I think a pullback into this level here will be perfect to get in for some nice longs. Yeah, that's what I'm kind of looking at there. GU, obviously pretty similar. I want to pull back into this level, and then I'll see, all right, maybe I'll add some statistical models to it. Maybe I'll look, all right, are we seeing some lower time frame changes in structure, whatever. That is when I might get into these GU shorts. Obviously, it was super overextended. I'd love for price to come up here and tag us in, but the current environment is not giving too many pullbacks, as you can see here. G-Swiss, this level here, as mentioned, you have to be very, very careful with G-Swiss. GA, oh yeah, that's actually a good point. DXY last week, our position hit, which was nice, right off the 98.75 handle on the Monday, and obviously that hit for a nice 1-to-1. GU didn't manage to get into anything, unfortunately, which is annoying, but what can you do? G-Swiss, we managed to catch that there. Wanted to catch a position there, but didn't get entered. That was nice. GCAD, I don't think we got in. No, we did get into GCAD actually last week. Yeah, we literally got in to the pip on GCAD. 2 p.m. on the Wednesday. We got into some nice shorts from that level. And similar level this week. We're looking for it to come to the 1825. This level here for some shorts. GA, definitely be very careful on this one, but I like the 1-9 handle is very key, and I think this could play out very nicely. NZD dollar, as mentioned, it's been falling off a cliff. I think the 0.5825 looks decent. NZD CAD, this level here, because it's quite a big level, I'll be looking for further confirmations. I might enter inside this demand zone. AUD NZD. Tough one because obviously we're very overextended. I didn't catch this 1 to 13, by the way. I was in this, but didn't hold it for a 1 to 13. Hold it to about there, which is obviously annoying, but what can you do? AUD/NZD, yeah. Price action's pretty... I mean, I'd probably get in here, but if we break past that level, then I'm going to be looking around here. I just don't really like entering when there's all this massive gaps. So yeah, these are the two levels I'm looking here. Yeah, dollar yen, we caught a nice position last week on dollar yen where we got in here on 11 on Thursday. Whoops. Essentially this level here, pretty much the same setup as this, looking for upside, although we definitely have to be careful of intervention as we approach the 160 handle. AJ, similar thesis. I think this level down here looks best, and I think we can reach it, to be honest. CAD yen, similar thesis down here. I doubt we'll come down here. If not, I'll be looking for something in this level, which we obviously hit on the Friday, but I think we can come back down, get a better entry. Euro CAD, shorts from that level there. Euro dollar, basically the inverse of the DXY. Swiss yen, I think a bounce from this massive level here could be good, but obviously you just need to be careful and probably get some more lower time frame confirmations. And obviously it's gold driven, so definitely be careful. NZD Swiss, similar thing, be careful, but this level looks most appealing. And in CAD Swiss, I really like this level for longs. I think this is a great level for longs. So yeah, that is essentially it with the technicals this week. And yeah, I mean, as always, for the people who are in the web app, I'll show you the homepage we're kind of building up, which should be very nice. If I flip my screen over. Yeah, so this is the homepage we're currently building, and we are planning on releasing soon. We just need to update some stuff, make it run a bit quicker. But yeah, this is essentially it. You've obviously got the live news feed there, why our market's moving today, all the central banks, what's happening with this. So yeah, this is a page we are about to release inside the web app. And as always, if you haven't joined the web app yet, there'll be a code in the description for 50% off your first month. So you can test it out, see if you enjoy it. Obviously, if not, you only paid 50%. I think it's around 20 quid, so it's not the end of the world. But yeah, as always, we'll catch you in the next Outlook, and yeah, let's have a good week.